Good morning, everyone. It is May 30th. Tomorrow's the last day of the month, and we wrap it up on a Friday. Interesting stuff. So, we had some decent movement. Some news came out this morning, and we saw that markets generally had a decent downside move into the end of yesterday, as well as throughout the majority of the overnight session right now, popping back up. So we'll take a look at the plan for the S&P today and see how things are shaping up, with the potential of more downside coming through with some elevated levels of volatility. Now, volume over the last few days this week has been fairly good. On the S&P 500 futures, we're opening the sessions up with over 200, nearly 250,000 contracts traded each day of this week, which all that volume pumping in presents opportunities for better movement. So yesterday was a bit choppier realistically. There were some great opportunities in terms of people getting trapped at the lows and at the highs before a larger move to the downside. So let's take a look at some of this news before we dive right into this. There was some news this morning that came out. Tomorrow, remember, we have the Fed's favorite inflation gauge pre-market PCE at 8:30, so that's going to be an interesting event that we want to take a look at. But this morning, what we got was U.S. GDP quarter over quarter second estimates. The expected was 1.3. It came out at 1.3. The prior was 1.6%. We saw U.S. jobless claims that rose slightly, right? The prior was 215,000. The expected was 217,000. We got 219,000. The U.S. GDP price index was 3.1 expected. It came out at 3. The U.S. core PC price advance was expected at 3.7. Prior was 3.7, and the actual came out at 3.6. So, expectations of drop in those inflation figures. We'll see how that shapes up tomorrow, but it helped this market rally a bit here pre-market. So let's take a look at some of the news that we got going on. There's some kind of private credit news, right? There's an emerging asset class that has grown from around $250 billion in 2010 to about $2 trillion today, and is set to expand by double-digit percentages in coming years. So the private credit market consists of private loans made by funds to privately owned companies, with money originating from sources like pension funds, insurance companies, endowments, and foundations. Private credit also leans excuse me. Jeez. The private credit also leans heavily on direct lending, one-to-one relationships compared to traditional loans, where money that is lent out is funded through bank deposits or syndicated among a group of investors. So it's fairly popular after what had happened in 2008, right? The banking crisis of 2008, where the Fed drove interest rates to zero, driving all the players in the market to compete for the same small number of assets that had any yield. This created an environment where alternative investments could gain an edge, while at the same time big banks pulled back on their riskier areas of lending due to increased regulations and a higher capital and liquidity rule. So it was part of a plan to move risks out of banks where taxpayers have protection, and eventually saw private credit that morphed into something of a very attractive investment on Wall Street. So investors want more of it, right? The warnings have grown louder as well. Back in November, UBS chairman Colm Keller said that there was clearly an asset bubble going on in private credit. What it needs is just one thing to trigger a fiduciary crisis, and the IMF also warned that the markets need more scrutiny due to the liquidity demands as well as the quality of borrowers. So the latest to weigh in on the industry was JP Morgan's Jamie Dimon, who noted that there might be a problem here, but I don't think that it's systemic, and the bank would even contemplate investing up to $200 billion in private credit off its balance sheet. So a lot of people have been talking about credit events, right? This kind of adds into that worry of potential credit events, right? They've been talking about it for a very long time, right? Eventually, they might be right if they keep screaming it for the next few years. But this is one of the latest, hottest things in the investment world that is starting to raise a few eyebrows and concern. So it wasn't distributed when rates took a turn higher in the fight against inflation, as loans carry floating interest rates. However, there are fears that this could eventually hurt borrowers overwhelmed by higher payments, especially if there is a severe recession or if there's compounded with other governance risks like weak underwriting standards or less liquidity or not so transparent environments. And those in the private credit industry say that their matched funding model is more secure compared to traditional banks that lend long fund short with deposits and can experience a run in moments of crisis. So while there's also a source of credit creation that can support the U.S. economy in this case. So we'll see how this shapes up. This is just one of the other things that the credit event screamers are going to start shilling out realistically. And not too much news, but the other thing that kind of popped out was Google confirmed to The Verge that there is a 2,500 leaked internal documents with details on data tracked by search giant are authentic. So the files contain info on Google's secret algorithm for ranking search results, which, along with its testimony in the DOJ antitrust case, shed more light on the kind of data the lending search engine collects and uses. We would caution against marking inaccurate assumptions about search based on out of context, outdated, or incomplete information. This is what Google spokesperson Davis Thompson noted in the statement. And we can take a look at GOOG, see what Googly's up to pre-market here. It is flat on this news, so nothing really to come to it. We're still very, very hawk-eyed on Nvidia because this thing has been just holding very, very high. And realistically, with the continuation of some downside pressure and some selling in the equity markets, Nvidia's not budging, holding up the Nasdaq itself. You look at the equally weighted S&P 500, right? It's down fairly significantly and it's pulling back off these highs. It didn't even make a new high. You take a look at the Dow Jones, it's also pulling down fairly aggressively, which is one of the leading indexes that I'm looking at, or I guess averages that I'm looking at to create the next potential move. We've also seen that VIX has jumped up a decent bit over the past few days, pulling off right now after this most recent rally on the overnight, but we're starting to get peaks up in volatility that can create a little more downside potential. But there's one little thing that's amiss with Nvidia that's holding a lot of things up, and just generally tech in itself is sustaining. Today we've got some other news that comes out. Pending home sales at 10, EIA petroleum inventories at 11. We got EIA natural gas inventories. We've got Fed's William at 12. We've got Fed's Logan at 5 p.m. and the Fed's balance sheet at 4:30 p.m. So let's take a look at these equity markets here with the futures on the S&P 500. We've seen a drag to the downside. Yesterday I was looking for some rebounds to actually sell into. Didn't quite get to my area of around 5,300, but very, very close before we sold off into the end of the day. A lot of volume and delta had accumulated pre-market and off the open to present that pop. Right now, we're below this mid-70 area. We tried to move below the distribution under 52.60, but we failed so far. And a move below that area would realistically initiate some more downside momentum. Some of the last chances are at 52.80, maybe 52.73, where we've got a decent amount of absorption actually right now. People getting trapped into that high trying to pull lower. So if the downside is going to come, we got to start breaking under that 52.60 realistically and following through with that. But so far, the RTH session, the regular trading hour session, has been riddled with kind of sideways movement and chop. So I will be looking for some downside, but I know where I'm wrong about that 52.80, and we'll go along with that. So what we're going to be doing is opening up our live trading room right now. We'll see you guys in there. Check out tradeproacademy.com, and we'll wrap up tomorrow with another live stream, and I hope to see you all there on YouTube. So thank you and take care. Let's open this up, and let's see how these markets